Well, now for the big news and the big instrument that's getting launched today, probably an asset class, and that's why it's so big. The Blackstone-backed Embassy Office Parks has launched India's first real estate investment trust, or REIT. It opens today. It's likely to be Asia's largest REIT by size. To tell us what this product is and how you and I can invest in it, or whether it's a product for us at all, Ashish Shankar, Senior Executive Group Vice President and Head of Investments at Motilal Oswal Wealth Management, Ramesh Nair, CEO, Country Head, JLL, Sunil Rohukali, Manager and CEO of the Ask Group, and our own real estate editor, Manish Anantrajan, join us. Gentlemen and lady, thank you very much. Manish, actually to you first. As a real estate editor, what are the first questions that come up to you? Is this the first time that people can invest in real estate as an asset class without being stuck that, oh, I've bought this flat and I can't sell it in my hour of need? Do you think the first liquid instrument has come?
Absolutely, Lata. The first liquid instrument has come, and I think more than just a flat, you have to look at the mouth-watering commercial real estate portfolio, which has actually outperformed most other asset classes over the last 5 years, and a retail investor just didn't have any choice of investing in that asset class. So you have a new asset class. You don't have to get into lumpy investments. It's transparent, 75 buildings that you can see. It's a simple investment in terms of you get what you see. Let me, of course, but also ask my panelists on what they're saying. I, of course, this morning wrote an article saying that you should bite into this particular investment if you've got that 2 lakh plus sort of surplus. It's a great asset diversifier. It is one of the best-in-class commercial portfolio. There are risks, though, and I think that's where I would like the panel to answer some of my questions. Ramesh Nair, the first question is to you. I know that the indicative yields have been about 8.25% quarterly and 8.5%. That's what, you know, the Embassy team has indicated to high net worth investors. But do you believe that the commercial cycle is right now at a peak, and that number, if rents don't continue to strengthen going forward, that number could be a little bit under pressure?
Good question, Manisha. We've seen the commercial demand over the last few years at 30 million square feet. Across the country. At 30 million square feet, India market is the highest absorption market in the world. That's one. Second is we've seen the industry consolidate. There are 12,000 developers doing real estate in India, but commercial is highly consolidated. There are 40 good developers doing that. Third is institutionalization. Almost 8 out of the top 10 developers today in the country have an institutional global partner like Blackstone or GIC or Qatar Investment Authority. So that's the next big thing. Fourth is flight to quality. We are seeing huge amount of improvement of quality amongst developers and tenants preferring to move to better quality buildings. If you look at per capita office space in India, we are just at 0.4 square feet compared to US, which is at 5, or other developed countries, which is much more. So that's a big thing. If you look at rentals today in Bangalore, most of Embassy's around 60% of the portfolio is in Bangalore. Bangalore vacancy today is at 3%. Anything less than 10% is considered extremely healthy. Bangalore rentals today, average rentals between $12 to $14. Comparable markets, Singapore at $90, Shanghai at $85. Again, a fantastic story. And the best thing is, I think, the sponsors, which is both Embassy and Blackstone. I would definitely rate Embassy amongst the top 10 developers in the country, and Blackstone's name needs no introduction. I think this is the first time we're going to be seeing predictability in commercial real estate. That's an asset class which has a lot of predictability. We're going to be seeing liquidity. If you want to sell, you put your 2 lakhs, six months later you want to take that money out, that's going to you can come out of that. And thirdly, given the volatility we've been seeing in the stock markets, whether last year's 4% increase of Sensex or minus 15% mid cap or minus 25% small cap, this is something where you can start today with 8.5% entry yield, and over a period of time, over a IRR looking at maybe a 13 to 15%. So
Okay.
I definitely don't believe the markets have peaked.
Okay.
We believe the next 3-4 years we would see similar amount of demand, unless tomorrow you see a Lehman kind of an incident
Sure.
happen.
Okay, well, no one can predict that, right? But there are some risk factors that I want to address as well, like taxation, for example. Let's invite Ashish Shankar of Motilal Oswal into this discussion. Ashish, before I ask you about the risk factors, from a wealth manager's perspective, what is the expected post-tax return that one would get on, say, this issue, and how does it compare with other investments?
Right. So first, let me give an asset allocation point of view, because that's what we look at in the wealth management business. On one side, you have fixed income, where your returns are reasonably predictable, but at the same time, there is no upside. So if you buy a bond at, let's say, 7%, 7% is what you get if you hold it to maturity. On the other extreme, you have equities, where there is variability in terms of the underlying earnings of the company, and you also have variability in terms of the sentiment, which is basically denoted by the price to equity. So these are two extremes in terms of risk. I believe that the REIT structure would be more of a fixed income plus kind of an instrument, because the underlying rentals from this portfolio will be steady over a period of time. There will be variability in terms of the market cycle, because at the end of the day, rentals in offices are very closely linked to the business cycle. But given that this is a diversified portfolio, there will be some stability in the underlying rentals. At the same time, unlike fixed income, here there is an upside possibility as well, because rentals get revised every 3 years, and normally the hikes are in the region of 15%. However, given that this portfolio, bulk of it is in, technology companies are the biggest leasers of this asset, there will be some headwind in terms of how much upside you can get. Because what I understand is the traditional understanding of technology companies is that they don't want to pay more than $1 per square feet. So obviously, unlike office premises, where the hikes in the rentals can be linked to the business cycle, here it will be slightly muted. But having said that, I think it's wonderful news that this is getting listed and the new asset class is getting created. I would say that this definitely merits a place in the HNI portfolio. However, coming to the second part of your question, which is on taxation. Now, the taxation part, to be very honest, is not very clear to me, because if I look at the projections in the offer document, at current distributable cash flows, the EV/EBITDA, I mean, at current prices, which is 300 rupees per unit, the market cap of this REIT structure is close to 23,000 crores. Now, they've also proposed to have 4,000 crores of debt within the REIT. So 27,000 crores is the EV. And if I look at the average distributable cash flow over the next couple of years, is closer to 2,000 crores. So EV/EBITDA is 13 times, and the yield is coming out to be about 7.4%. Now, of course, if you go further ahead, the next 4, 5 years kind of projections, then, the 8.5% kind of yield is what the embassy is projecting. But then there are risks there. So I would say that as an investor, if I were to invest, I will invest with an expectation of anywhere between 7.5% to 8%, with an upside coming in from the revision of rentals. So another 4-5% kind of upside can come in. Now, how they distribute the cash flows, whether it's in the form of interest income, whether it's in the form of rental income, and finally, what is the taxation in the hands of the investor, is not yet very clear to me. So HNIs will ultimately take a decision for a big allocation depending on what is the post-tax income that they get. Because if you look at all the traditional forms of investing, whether it's equities, mutual funds, ultimately what HNIs are concerned about is what they get after paying taxes. But it's definitely an asset class that...
it's an asset diversification.
Asset diversification, and one should nibble into it, not be in a hurry, because I'm sure there are other people also who will come and list
actually, that is what I want to ask Sunil Rohukale. Sunil, good morning. Will there be someone to buy? Is there a market? Is there a market maker?
See, Lata, I think after over a decade, after a long wait, the real estate industry has seen the new avenue, new opportunity, new asset class. And we all know that in last 5-7 years, we as an industry, real estate as an industry, has been moving from informal to a formal, private to a public. So I clearly feel that the real estate was widely hailed as far as residential is concerned, as far as the world-class A-grade office buildings are concerned. These are hardly been an opportunity for ultra HNIs and individuals to really hold, because the quantum of the money required was beyond their means. So I clearly feel that at this point of time, because this is a new opportunity, and this opportunity has to be seen into perspective of asset allocation, as you rightly mentioned. this is not the fixed income product, it is a fixed income plus product. So this particular asset class has got there is a potential development risk, but to that extent it is small compared to the portfolio what they have already built, leased. So the risk of vacancy, the risk of the economic cycles, and the risk of the rental reset, correct, or increase in the rental. So my guess is that 2 years back, the commercial real estate market has troughed out, the rentals are stable, they are growing, the vacancies are much lower across India, the new asset classes, the new buildings which are there in the hands of other institutional investors and not really in the developer. So it is a great instrument for a liquidity event for a developer. It is a liquidity event for the foreign institutional investor who has invested for 10 years plus in this market. I clearly feel that participation by the ultra HNI and institutions is going to create a market making situation for this particular instrument. And you will see it is a beginning. I clearly feel that this year you would have at least one or two or maybe a couple of more would be planning to do the similar kind of thing to expand the market.
Okay. Actually, I want to toss that to you, Manisha. Do you, as Sunil says, do you think if somebody invested, they will be able to liquefy it? Somebody will be there to buy? And as Sunil says, do you think that there would be other people who will follow suit? I mean, take it away. What are your thoughts and what are your questions?
All right, let me address the liquidity concerns first. So, you know, there is a consultation paper with SEBI bringing down the size of the investment to 15,000 rupees, not 2 lakhs. I think SEBI did not take that big step for the first REIT or right before the IPO because they just wanted, you know, high net worth investors or investors who are financially savvy to dip into the new product. But if that goes through, I think there will be much more liquidity, of course, which will come into the market. Somebody who has 15,000 rupees will also be able to buy. When will that happen? We don't know, but SEBI is seriously considering it. And I think that will benefit overall the REIT liquidity after listing as well. The way I see it, it is looking like there's going to be an oversubscription. 55% of the book is already allotted to anchor investors and the Capital Group, which is a large, hefty financial services organization based out of the United States. So, you know, we have a very limited book left now. So 25% of the retail investors plus institutional investors, I think there will be oversubscription, which also indicates that, look, there will be some people who would be left out and would like to bite into the REIT on listing. On the taxation front, you know, Ashish, of course, did mention that one is not clear. Yes, you can't be clear because, you know, you have rental income. You also have interest income coming in from the money that the trust just gives to the SPV, and interest income will be taxed at 30%, but rental income is dividend free. So, you know, a blended rate, I have spoken to the CEO, Mike Holland, and he says blended rate of taxation, which a high net worth investor or investor biting into REIT should expect to pay is about 15%, and that should remain at least stable for the next 3 years. So I think post-tax calculations can be made on that parameter. On the next REIT, well, I think depending on the election results and how this REIT does, Lata, somebody else will take that plunge. Okay. But yes, there are good assets. Raheja Group assets are there. You know, those have not been part of this REIT. You have also assets from Panchsheel Group. So there are some very robust, good quality commercial assets which Blackstone is invested in, and they may decide to go in for another one if this one is successful.
Okay, so the consensus view, at least on the yield aspect, is that it could be around 7.5% to 8% right now. But Ramesh, I want you to come in on a point that Ashish was making. There is an upside possibility to the underlying lease rentals because of commercial demand picking up, and that could take the yields higher eventually. What's your own view on that, and what are you looking at as the yield for this issue?
Yeah, Sonia, there is definite upside potential. Okay, you're getting a yield of around 8.5 entry point. You also have escalation. So every 3 years you get an escalation of 12 to 15%. That pushes up your rental income. There's also mark to market. A lot of these properties today are rented at less than 30% of the market because these tenures have been fixed, like 6 to 10 year kind of tenures, which were fixed a few years back. So as soon as those tenures end, there's an opportunity to increase. And right now we are not even talking of cap rate compression given the current interest rate environment, but when Blackstone started buying 6 years back, cap rates were at 12%. Today we are talking of a 8.5% cap rate. We definitely see that cap rates, not this year, but over the next few years, definitely dropping. Many developed countries' cap rates are between 2 to 3%. I'm not saying it's going to go to 2 to 3%. Plus, one also needs to remember that out of this portfolio, only 89% is completed. Balance 11% is developable assets. And these developable assets, there is definite potential for higher rentals. So that's where these 2-3% each, which adds to that 8.5%, becoming a 13 to 15% IRR, are these extras which we will see playing out over a period of time, not today.
Unfortunately, completely out of time. But Manisha, 10 seconds for you to have the last word. Do you think this is a new avenue for real estate entities to raise money, circulate their money?
Absolutely, it is, and that liquidity is much needed, as we all know, for the sector. But, you know, I would like to add to Ramesh's point. This might be India's first REIT which is getting listed in India. But, Lata, there is an Ascendas Trust REIT which is listed in Singapore. That's Ascendas India Trust, which has IT parks. And, you know, if you look at the performance from the time of its listing, 2007 to now, it's actually outperformed the Nifty 50 by 430 basis points. So let's just looking at the numbers, I think that 14-15% number we shouldn't write off as of now. 8.5%, 8.25% is the start. And we're keeping our fingers crossed because the sector really needs liquidity and this REIT to be successful.
Okay, well, lady and gentlemen, thanks a lot for joining us. We've run out of time, but this was really an enriching discussion on whether or not you should invest into the REIT's asset. But for now, the market has come off from the day's highs. It's still holding with gains of about 0.5%. Mid-caps have flattened out entirely. With that, it's curtains down on Bazaar. Thanks so much for watching. Lots of trading ideas lined up on Chartbusters.